Yes, as through this world I've wandered, I've seen lots of funny men. Some will rob you with a six-gun, and some with a fountain pen. The financial crisis of 2008 is considered the worst economic crisis since the Great Depression. Now, over a decade later, are we again heading towards Great Depression? In this video, we will discuss several signals which indicate that we could be on the verge of economic meltdown. Argument 1. Inverted yield curve. The yield curve is a graph charting the rates on treasury bonds. The slope of yield curve gives an idea of future interest rate changes and economic activity. There are three main types of yield curve: normal, inverted, and flat. The curve normally steepens in a growing economy because investors demand higher yields on longer dated bonds in case of inflation. Typically, long-term bonds have higher yields than short-term bonds, but an inverted yield curve reflects a scenario in which short-term debt instruments have higher yields than long-term instruments. An inverted yield curve is often seen as an indicator of impending recession. Should we be worried about yield curve? Yes, because it inverted for the first time since the 2007 financial crisis, warning that investors expect an economic slowdown. It shows that US is headed towards a recession in 2020. Going by historical data, the significance of an inverted yield curve in predicting recession cannot be ruled out. In March 2019, inversion of the yield curve hit 3-month T-bills for the first time in about 12 years when the yield on 10-year notes dropped below those for 3-month securities. That metric reverted and then inverted again in May 2019, which is now trading at negative 36 basis points. Risky, risk-free assets. Stock markets are going up. Venture capital may be overvalued and firms are highly leveraged. But if one asset class stands out for its high prices and potential systemic risk, it's supposedly low-risk bonds issued by governments in US and Europe. Since many investors are mostly concerned with preserving capital, risk-free assets like treasury bills are safe options which offer a certain return over a short period of time and are easy to buy and sell. Demand for safe assets is global. However, only a few big stable countries like US, Germany, and Japan are producing these safe assets, meaning that the demand for these safe assets outstrips the supply, making these supposedly risk-free assets risky, and the prices of these assets are increasing their fundamental value. Normally, prices would adjust accordingly as seen in this diagram, with yields falling and prices rising until they reach an equilibrium. But there is probably a limit on how high risk-free asset prices can rise, or put another way, how low or negative interest rates can fall, creating a bubble. A risk-free bond bubble may pose more systemic risk to the economy than a standard asset bubble. The risk-free asset interest rate is the foundation for everything. If this bubble burst, whole economy would collapse.
Bill Gates, the world's richest man, has a fortune of 65 billion euros. That's the market value of his shares. To compare, the total value of all of the world's cash is less than 100 times that amount, 5 trillion euros. The value of all goods and services created every year around the world is 75 trillion euros. That's the real economy. The world's debts are far higher than that. States, businesses, and private individuals all have debts. A world living on credit. 705 trillion, that's the value of all derivatives, the speculative financial bets on the future. They've got almost nothing to do with real goods anymore. To recap, this is the fortune of Bill Gates.
According to the final report of the National Commission on the Causes of the Financial and Economic Crisis, in 2008, the losses were magnified by derivatives such as synthetic securities. Where are we today? The derivatives market is, in a word, gigantic, often estimated at more than $1.2 quadrillion on the high end. Some market analysts even place the size of the market at more than 10 times of the world's gross domestic product. This approach had opened gaps in oversight of critical areas with trillions of dollars at risk, such as the shadow banking system and the over-the-counter derivatives markets. The growth in globalization, derivatives, and leverage over the past 40 years has made a financial panic impossible to contain. Many banks have shifted their swaps overseas to avoid US regulations. Although all G20 countries agreed to regulate swaps, not much has been done. China has so far weathered the dual threats of trade war and a rising dollar well. The most likely causes for a China-triggered global crisis would be a real estate crash or rolling defaults by local government-owned fundraising vehicles, severely damaging bank balance sheets, tanking investments, and driving big capital outflows. This graph illustrates the growth of debt as a percentage of China's gross domestic product since 2010. China and the US are two major global economies. When external demand weakens, China pumps up investment at home, as it did in 2009. Its growth has been powered in part by one of the fastest build-ups of debt in history by a major country. That would worsen any financial crisis at home. Abroad, a weakening of China's economy might drive down prices for commodities and the value of many emerging market currencies, prompting widespread dollar bond defaults which could damage Western lenders. Chinese capital fleeing the country would sharply drive up the dollar. Slower emerging market growth would hit US and European exporters. Argument 2. Flawed predictive models. According to Jim Rickards, an author on matters of finance, the next financial crisis will be bigger than 2008 because the current financial system is based on flawed predictive models. What's the science behind a financial model? First of all, let's focus on what Wall Street and most financial analysts do because that is badly flawed. These predictions are off by large magnitudes year after year. How can you be wrong for 8 years in a row and still hold credibility? There's actual good social science research that shows that economists do worse than trained monkeys on forecasting. We are not saying this in a disparaging way. Here is the science. According to Don Peppers and Matt Rogers, the Wall Street Journal once reviewed its own surveys of top economist predictions since 1982 and found that the average expert correctly predicted the direction of interest rates just 22% of the times. Every year, the Fed does a one-year forward forecast. So in 2009, they predict 2010. In 2010, they predict 2011, and so on. Have a look at this chart. This chart shows the actual path of interest rates. And then along the timeline on the x-axis, it is shown what people were predicting over the years. The predictions are always off the actual path. Meet your new financial guru. A monkey knows nothing. So if there is a binary outcome like up-down, high-low, growth recession, and you ask a monkey, it will be right half of the time. Economists are wrong more than half of the times because of two reasons. One, flawed models based on obsolete data. Two, herding and group behavior. Well, the coronavirus emanating from China hit global growth. Could it tip the world into a global recession? It is an interesting question. It is something that analysts have been comparing to the SARS virus in 2003. But the truth is that the world is much different now than it was back then. Back then, China was still emerging in the global economy. But over the years, China has made up the biggest percentage of global growth, about a third of the total economic growth in the world, which is a higher percentage than the US, UK, Europe, and Japan combined. So, what happens in China matters most. That is both a consumer story and a business story. If you look at outbound Chinese tourism, it is a big part of the global tourism industry. In the US alone, before the US China trade war started slowing things down, the Chinese were coming to the US and spending $7,000 to $8,000 over the course of 2 weeks. That is a much richer impact for tourism than an average tourist. European countries and particularly Asian countries are now being hit as Chinese consumers pull back because of the quarantine. But coronavirus is not just a consumer story, it is also a business story. It is not only Chinese consumers who may drive a slowdown. The Wuhan region is a huge area for supply chains. Travel bans have made it difficult for people to work and to keep factories running. It is possible that with enough supply chain disruptions, China will not be able to meet its US trade deal purchasing commitments. That would, of course, have a geopolitical impact which could further hit growth. Bottom line, look out for coronavirus to be a big part of the global economic story this year.
The ultimate solution. This entire financial system that revolves around greed is eventually doomed to fail. The proper application of Islamic banking system will help reduce the effects of global economic crisis at any given moment for its outstanding ability to rectify disorders resulting from the application of contemporary capitalism. Allah says in Quran,
يمحق الله الربا ويربي الصدقات والله لا يحب كل كفار أثيم.
meaning Allah destroys interest and gives increase for charities. In the financial crisis 2008, $11 trillion in household wealth was destroyed, with retirement accounts and life savings destroyed. With regards to loan for consumption purposes, in times of need, ethical considerations demand that people should help each other out without charging interest, because to charge interest amounts to taking advantage of a person's weaker economic position, which is against the Islamic spirit of justice and equity. Now, great responsibility lies on Islamic banking to prove its ability to provide the Islamic alternatives to face the repercussions of financial crisis, focusing on financial instruments and Islamic products, whether in attracting or investing capital.